Welcome everyone to another installment of Record Time. So in this video series, or in this specific video, we'll be looking at the intricacies of valuations of companies once more, specifically focusing on relative valuations. Now, before you watch this video, we highly recommend that you look at part one of these valuation series for companies. So in part one, we introduced the basic concepts of doing valuations, what the outcomes of those valuations are, and how the intricacies come in when you're trying to integrate different valuation models in tests and exams. So hopefully you've watched part one, and now you're looking at a deeper dive into relative valuations, which is what we'll be covering in this video. Before we start, we'd like to remind everyone to please subscribe to our channel. Please like and comment at the end. Your likes and comments are able to build traction in these videos so that we're able to share our message with a wider variety of audience so we can make the difference that we want to make. Okay, without wasting time, as we've already alluded to, today we'll be looking at relative valuations. Now, at its basic form, a relative valuation involves valuing a comparable asset, right? Now, this comparable asset could be listed or it has some type of observable information. So it involves using the value of a comparable asset in order to determine the value of another asset. This is the basic premise of a relative valuation. Now, once you understand this basic premise, you then have to understand the second element, right? Whenever doing a relative valuation, there are two important components that you must understand. Now, the first one is the multiple. So the concept is that if you take some type of multiple, now this multiple could be of a comparable company that's listed if you're trying to value an unlisted entity, or this multiple could be an industry average or a sector average if you try to value a listed entity. And the idea is that if you take this multiple and you multiply it by some type of maintainable earnings, maintainable earnings. Now, these maintainable earnings being of the company that you try to determine the value for, i.e., this asset. So when you take a multiple of a comparable entity here, and you multiply it by the maintainable earnings of the company that you're trying to value, right? Outcome of this will be the value of the asset or the company that you're trying to value. And that's the basic premise of evaluation. Now, this formula is extremely crucial. If you can always remember this formula, that when doing a relative valuation, I need to take some type of comparable multiple and multiply it by the maintainable earnings of the company I'm trying to value. The product of the two will be the value of the company that I want ultimately at the end of the day. Now, let's unpack deeper as to what do we mean by multiple and what do we mean by maintainable earnings. Now, when we look at a multiple, now the concept of a multiple, right, differs depending on whether you're looking at a listed entity or a non-listed entity, right? Now, from a listed entity perspective, right, when we talk about a multiple, we're talking about, as we've already alluded to, we're talking about an industry average or sector average. So, for example, if the company I'm trying to value is listed, however, it's in the financial services industry, when we talk of the multiple or comparable multiple we should be using, we're talking about the industry average of other similar financial service companies. The same would apply if it was in the food or retail industry. Then we'd look at the industry average multiple for the food industry in that respect. If it's an unlisted entity, right? What we're basically talking about here from an unlisted entity perspective, we're looking at a comparable entity. Comparable, listed entity, multiple. So again, that's a very crucial and important distinction, right? If in a test and exam you're asked to value a listed entity, always understand that when you look at the multiple, it must always be an industry or sector average. And that makes sense, right? Because entities that are listed already have information about their own respective multiple. However, now you're trying to look at what is that multiple relative to other comparable multiple. So it should be an industry or sector average. However, when your entity is unlisted, it's not trading on an exchange. So you don't have that information readily available. So therefore, we always use a comparable listed entity multiple that's listed in order to determine that multiple. Now, we've referenced multiple quite a few times, and you now understand the perspective of a multiple when you're looking at a listed entity and an unlisted entity. But what exactly do we mean by multiple, and what are the type of examples of multiples that we get? Now, at a basic core, a multiple is a ratio, right? Now, the ratio could either be broken down into a price ratio or it could be an enterprise value ratio, right? So what are the common price ratios that we see that serve as multiples? The first and I guess the most common one is what we call the PE ratio. Now, the PE ratio, simply put, the formula is the share price of an entity divided by the earnings per share. Now, the price earnings ratio looks at the relationship of a company's share price relative to its earnings. So if I have a PE ratio of example of, let's say, share price of 10, earnings per share of 1, so therefore giving me a PE ratio of 10, what does this mean? It means that the market is willing to pay 10 times for every 1 rand of earnings the company make, right? So every 1 rand of earnings the company is making, the market is willing to pay 10 times that value, right? So it's pretty decent, P ratio of 10. Okay, cool. Now, very important for you to understand that these price ratios could vary. Now, we've discussed the PE ratio, but in a testing exam, you could easily also get a price to sales ratio. So a price to sales ratio would basically be the share price divided by the sales of the company, the sales for the company per share, right? So you could easily look at the price to sales, which is which is the share price divided by sales per share. Another variation that we could also see, right, and that's quite common, is what we call the price to book. Now, the price to book again is the share price of an entity divided by the net asset value per share of a company. Again, don't memorize these ratios. What you have to understand for test and exam purposes is that price ratios are a form of multiple that we use in relative valuations. And specifically, that a price ratio will measure the relationship between the shares of a company or the share price of a company and some other line item in the financial statements. The line item could be earnings, in this case, earnings per share. It could be sales, in this case, could be sales per share, or it could be the net asset value of a company, which is NAV or book value per share. It all depends, but that's the basic premise of price ratios. Now, we've looked at price ratios, but what about enterprise value ratios, right? How do enterprise value ratios come about? Now, what you need to understand from an enterprise value ratio point of view is that the same concept, but now it's looking at the concept of an enterprise value to some kind of or relationship between the enterprise value of a company relative to the line item in the entity. So in this case, we could have enterprise value to sales. So now what this would be is the enterprise value of a company divided by the total sales. Or we could have enterprise value, EBIT, which is the same as saying the enterprise value of the company over the EBIT of the company. Or we could have again enterprise value to book, which is the same as saying enterprise value over the total net asset value of the company. Now, the first thing I want to draw your attention to is the concept of enterprise value. So, what do we mean by enterprise value, which is important from your perspective? Now, enterprise value is the same in this case as saying the fair value of the assets of a company. So if you take all the fair value of all the assets of a company, then you will get the enterprise value. And specifically, there could be even a nuance that these assets would be operating. Right. So if you take the fair value of all the operating assets of a company, then you should get the enterprise value of an entity. Cool. That's very important for you to understand. So that's what we mean by enterprise value. The second distinction that I want you to draw from these two ratios is that this one was looking at from a total perspective, where this one was looking at from a share perspective or per share, a per share perspective. Now, it doesn't matter whether you look at these ratios from a total perspective or or per share perspective, they will ultimately give you the same type of relationship. For example, an enterprise value to sales ratio could have also been written as enterprise value per share divided by the sales per share. So it could have been enterprise value per share to sales per share ratio. Similarly, here we looked at the PE ratio and it was the share price of the earnings per share. This could have easily been written as the market capitalization. So remember, guys, the market capitalization is the same as saying take the share price of the company, multiply it by the number of shares. So if you took the market cap of a company and you divide it by the earnings, so in this case, not the earnings per share, but the earnings. Now, the earnings is usually profit after tax. So if you take market capitalization divided by profit after tax, so now you've deleted the concept of number of shares, you will still get the same PE ratio. Cool. I hope everyone is happy with this example. Importantly, that you also remember from our part one series is that it's not enough to understand how to do the calculations. It's also important to understand what the outcome of each calculation will be. So, for example, if you look at a price earnings ratio, a price to sales, a price to book, outcome of this will always be equity. And that's important because a shareholder or an equity holder will always look at the share price and the dividends of an entity in order to track how their investment is doing. And that's why whatever model or valuation model we use that incorporates either share prices or dividends will typically give us the equity value straight. So that's why the outcome. So when you use a price multiple to do a relative valuation, you must always understand that the product or the answer you get from that valuation will always be equity. However, when you look at enterprise value, as we've mentioned, this is the value of the assets, right, of an entity, operating assets at fair value. So because these are the fair value of the assets of an entity, the outcome here will definitely be the fair value of the assets, which are operating. What does this mean? This means you must still add my non-operating assets, right? Then whatever you get from your non-operating assets, right, will then give you my total assets at fair value. Now, guys, if you remember the accounting equation, right, assets equals owner's equity plus liabilities. And remember, we want owner's equity. So assets minus liabilities will give me my owner's equity. So if I get my total assets fair valued, right? So after I've done my multiple valuation and I get my fair value of the assets that are operating, and then I add my non-operating assets, which are typically valued separately, I must still subtract the liabilities fair value. And only once I've subtracted the liabilities fair value will I then get the equity value of the company, which is basically this amount. So this is a very important distinction to also understand when you're doing your testing exams, is that you always need to understand when you're using enterprise value ratio, the outcome of this is the enterprise value or the fair value of the assets which are operating. I must always then remember to add my non-operating assets, then subtract my liabilities at fair value in order to get my equity value. Cool. So I think at this stage, we've covered multiples. The next step is the next building block, which is maintainable earnings. Now, maintainable earnings. So when we talk about maintainable earnings, there are two things that I want you to reference. The first one is that maintainable means they must be recurring. So always make sure that when you're doing valuation, right, and you try to determine the maintainable earnings, strip out items that are in your valuation that are non-recurring. So they must always be recurring. The next one is that there must be a matching to the multiple. So, i.e., your maintainable earnings will always equal the denominator of your multiple. This is important. So maintainable earnings will always equal the denominator of your multiple. So let's go back. So let's look at one of the price multiples that we looked at was the PE ratio, right? So if our PE ratio, in this case, we know that it's the share price over the earnings per share, right? So if I want to determine the value, right, of a listed entity, right, then in this case, I must take my multiple, which will be my share price over the earnings per share. Now, remember, this will be my multiple. Now, this multiple must be multiplied by my maintainable earnings. But what is my maintainable earnings? My maintainable earnings will always be the denominator. So in this case, you must multiply it by the earnings per share of the company trying to value. If you do this, you'll then get the value of the entity. Now, this is a very important concept. Let's look at again a similar context. Let's assume now you used price to sales. To sales. So this is the same as saying the share price of a company divided by the sales per share of the company. Therefore, if I want to determine the value of this entity, I must take the share price of the entity divided by the sales per share, and then I must multiply that by the sales per share, and then I'll get the value of an entity. This will be on a per share basis, the value of the entity per share. Cool. Very important nuance for you to understand that there must always be a matching. So whatever your denominator is in the equation must always be what your maintainable earnings is in this case. Cool. Now that we've looked at that important concept and we now understand what maintainable earnings are, the next step is to look at an example that will crystallize everything together. So assume that in this case, we're going to start with valuing a listed entity. So we'll start with a listed entity example. So assume that we've got A Limited, right? And we're told that A Limited is currently trading with a PE ratio of 12. We're also told that the PE ratio of the financial service sector, now A Limited is in the financial services sector, is sitting with 17. We are also told that A Limited has an earnings per share currently of 2. Now, we're also told that the profit of this entity is sitting at 1 million. So the profit after tax is at 1 million. We're also told that included in this profit is a contract or revenue from a contract that is valued at 50,000. That was for that 1 year. So it's not expected to continue in the future. It was only for that 1 year. It was a once-off revenue. Cool. And we're also told that the number of shares issued by A Limited is 500,000. Now, the share price of A Limited is currently 20. The question is, in this case, simply, should we buy these shares? And this is how your test and exams will usually be driven. There'll be some type of decision you need to make, right? So you're given all this information, right, about A Limited. The question is, should you buy the shares of this entity? Now, the first thing you should be thinking in this case, because I've got a listed entity and they give me information about a multiple, right? So these are price multiples. So therefore, the only logical valuation technique I can use here is a relative valuation. Now, I need to understand what the value of A Limited is, and I then need to compare it to the share price. That value, if it's higher than the share price, will ultimately tell me that this company is worth buying. However, if it's less, it will be an indicator that it's not worth buying. So now, how do you go about determining the value of A Limited? Right. So what we'll do, we'll start off by saying, okay, we know that in a relative valuation, we must say, must have a multiple and we must multiply it by the maintainable earnings. Now, first things first, what is our multiple in this case? So we're given the PE ratio of A Limited, which is 12. We're also given the PE ratio of the industry, financial 17. Which one do we use? Absolutely correct. If you guessed it right, we need to use the PE ratio of the industry. Remember, we're valuing a listed entity. And in a relative valuation, you always need a comparable multiple. Now, the comparable multiple will be an industry or sector average if the entity that you're trying to value is listed. However, if it was unlisted, it would be that of a comparable entity. So in this case, we'll then have to use the 17, which is basically that of the industry average, right? We're also told that the earnings per share is 2. And you can already see how they got this earnings per share, right? So if you do a formula, if you take the profit of 1 million and you divide it by 500,000, which is the number of shares in issue, you should get 2. So that's how they got this earnings per share. Now, the question is that earnings per share, or before we even get there, right? We know that the first part of our formula is done. We're going to say 17, right? But we need to multiply this by the maintainable earnings, right? Now, because we used the PE ratio, we know that it was the share price over the earnings per share. So our maintainable earnings has to be the earnings per share, right? We need to multiply this by the earnings per share of A Limited. Now, the question becomes, we are told that the earnings per share of A Limited is 2. Do we use this 2 in our calculation? Now, if you said no, absolutely correct. Now, remember, guys, the maintainable earnings has to be recurring. This is the most important concept that you will take away today. The maintainable earnings have to be recurring. So in this case, we start off with a profit of 1 million, right? But we're told that inside this 1 million, there is a contract of 50,000. This contract is not expected to continue in the future, i.e., it's not recurring. Because it's not recurring, we need to remove it from profit after tax in order to get our maintainable earnings. So therefore, because it was increasing, to take it away, we'll have to decrease. So therefore, our maintainable earnings, right, is actually 950,000. Now it's this 950,000. Now we're going to have to determine our maintainable earnings per share. Our maintainable earnings per share will therefore equal the 950,000 divided by the 500,000, which then should give us an earnings per share that's 1.90. Very important. Now, because of the concept of maintainable earnings, this 1.90 is different to the two, right? Because we've reduced it by the fact that there's a contract that we don't expect to recur in the future. Now, I need to determine the value of A limited. So the value of A limited will therefore be the 17 in this case, which is the multiple of the financial service industry, times the maintainable earnings per share of A limited. And the answer we get here is 32.3. Right. So that's the ordinary equity value per share of A limited, which is the same as the value of A limited per share. So the share price, the value is 32.3. If you recall, what was the share price, guys? The share price was sitting at 20, right? So should we buy or sell? Absolutely, we should buy in this case. We are going to buy. Why? Because the value is higher than the share price. Because our value of 32.3 is higher than the share price of 20 Rand, we're actually going to buy these shares. Because we understand, as you recall from our part one video, that markets always are drawn towards the values in the long run. So the share price will catch up to the value in the long run. So if we buy now at 20 Rand, we stand to make a profit of up to 12 Rand and 30 cents in the future when the share price ultimately goes up again. Boom. So this is how you do a relative valuation for a listed entity. Hopefully, you now have a better grasp and understanding of how to do relative valuations from the perspective of a listed entity. Now, let's look at how you do the relative valuation if the company was unlisted. The first thing you need to understand when you're trying to do a relative valuation of an unlisted entity, the principles that we learned for listed entities stay the same. I.e., ultimately, you want to take some type of multiple. You want to then multiply this by some type of maintainable earnings in order to get the value of the company. That stays exactly the same. So the formula stays the same. The only difference that we start seeing, right, and you'll recall from earlier on, is that in an unlisted entity environment, instead of using a sector or industry average, we're going to use comparable entity. Comparable entity multiple. But the rest of the stuff will stay exactly the same. So let's look at an example in order to be able to illustrate this point and hopefully be able to unpack it so that you understand it better, right? So let's assume in this case, we've got X Pty limited. Now, X Pty limited, for the purposes of this video or for the purposes of this example, we're going to assume has a maintainable earnings. So this has already been adjusted for non-recurring stuff. It has a maintainable earnings per share, right, of basically let's say a maintainable earnings per share of 10, right? It's already been done. So the maintainable earnings per share is 10. However, we're told the following information. X Limited is a food retailer, right? Right? So a food retailer like Woolworths, Pick and Pay, Spar. So that's what they are, a food retailer. Now, in relation to them being a food retailer, we're also told that the following information is relative to other similar food retailers. You've got company A, right? And company A has a PE ratio of 17. Company B has a PE ratio of 18, right? And company C has a PE ratio of 30. And then company D of 30, then company D has a PE ratio of 100. Now, we are told that in the example, A, B, and C are what you call comparable entities. These are the comparable listed entities. We are also told that D is a similar entity, similar listed entity. Now, the question is, how do we get the multiple of this entity in this case? Right. So we know that when the entity is unlisted, right, we need to determine a comparable multiple, right? Or we need to determine the multiple relative to comparable entities. So in this case, we can already start eliminating D, right? B is not a comparable entity, guys. It's a similar entity. So always watch out for this in a test and exam. You must use comparable listed entities. Similar entities, right, will simply not cut it. It must be a comparable entity. So when we talk about a comparable entity, this would be entities that have the same business model as us, same clients or similar clients, similar business model, similar strategies in the similar industry or sector to us. That's what I mean by comparable entities. And typically in a test, they'll either tell you that these are comparable entities or they'll give you enough information to be able to determine which entities are comparable and which are not. So because we've got three comparable entities, the most common thing here would be to determine an average of these three. However, I hope someone watching here today will be able to pick up there's a problem, right? Absolutely. If you guys figured it out, we've got a problem with C. C has an abnormally high PE ratio. As you can see, the PE ratio of C is 30, whereas A and B are 17 and 18. So C appears to be an outlier. So therefore, again, even though C is a comparable entity, we are not going to use C from our perspective because it appears to be an outlier. So it's not comparable per se to what we want to use. So that's the second exam technique that you must pick up. When you're determining your multiple for the perspective of valuing an unlisted entity, always remove outliers. Now, outliers can come in various forms. It can be entities, for example, that have negative price ratios or negative EBITDA ratios, or it could be entities that have ratios or multiples that tend to be out of sync with other entities in that industry. So in this case, C has an abnormally high PE ratio, so therefore it's an outlier. We remove them from our valuation. Cool. So therefore, if we want to determine our multiple, right, which will basically be the PE ratio of A plus the PE ratio of B divided by 2. So therefore, we're going to use the 17.5 as our comparable multiple. We'll use the 17.5 as our comparable multiple. Now, the question asked us to determine the value of X Pty limited. Now, this 17.5 multiple, do we stop there? Guys, we don't stop here. Another important element, especially when we're looking at determining a comparable multiple, is understanding that, hang on, entity we're trying to value is unlisted. However, the multiple that we're using is for a listed entity. So we'll always have to make adjustments before we can be able to use this multiple. So what type of adjustments would we have to make here? The most common one is the adjustment for liquidity and marketability. Now, shares that are not listed compared to shares that are listed, because of the fact that they are not trading and if they are illiquid, it's difficult to get rid of them. So because of this concept of liquidity and the fact that these shares are not easily marketable, there will always be an implicit discount that I have to factor into when determining a comparable multiple. So in this case, we'll start with the 17.5, but we'll apply the discount for liquidity. So let's say this will be a minus. So this will be a minus. Let's say we make this minus 2.5, for example. So reducing the value of the entity by reducing the value of that multiple to take into account the fact that the entity we're trying to value is unlisted. So therefore, there's a discount for liquidity that we must incorporate in the multiple to show the fact that it's difficult to sell these shares. What other adjustments could we have? For example, growth. If in the scenario they tell us that X Y Limited, right, the entity we're trying to value, is growing significantly slower, for example, than the comparable entities. That's a bad thing. So if that's a bad thing, we'd probably want to reduce by growth. However, they could tell us, for example, that XY Limited is of a bigger size, right? So that could again be a good thing when we could have to increase the value there. So instead of subtracting here, we could actually add the 0.5. So let's say we're smaller, right? So the fact that we're smaller, that could also be a bad thing, right? So if we reduce the fact that we are growing at a smaller pace, we are also of a smaller size. However, if we're a bigger size, it could have been a plus. If we're growing faster, that would also be a plus, right? What about the fact that, let's say, for example, we're profitable, let's say we're making massive profits compared to the other entities, and we expect these profits to continue in the future. That could be a good thing, right? Profitability and cash, right? That could also be a good thing. That could also take us back and make sure that we are in a winning position. So let's say, for example, the profit impact in this case could be positive 3.5, right? The good thing, we're making significantly higher profits. We've got more cash, higher margins. So our business is basically better than our competitors. So ultimately here, the important thing is not necessarily determining the amounts. You get marks for understanding that I must make adjustments for discounts, for example. This will always be there. The discount for liquidity and marketability. Then the others will typically depend on the scenario. For example, you get a mark by understanding that we're growing slower. It's a bad thing, so it reduces the size of a multiple. Whereas we are smaller, I'd also reduce. However, we're more profitable with higher margins, higher customer base. So therefore, that's why we were at 3.5 in this case. Then overall, you then have to look at the net impact of all of what you've done here. So the net impact of this would be, there's the 2.5, and you reduce by 3.5 in this case. Let's say the profit. So in this case, ironically, we end up with 17.5, right? But it's not to say this will always be 17.5, right? Yeah. So in this case, our adjusted PE ratio, this is the adjusted one, ended up being 17.5 in this case, right? So, and I guess maybe to illustrate the point home, we probably want to make this 2.5. So let's make this 2.5, right? Or 4.5. Also. Yeah, 2.5. If we make this 2.5, then we'll get 16.5. And I guess maybe I want to change it because I don't want you guys to think there's always be a neutral adjustment, right? You could always get an adjustment up or down. But again, as I've illustrated, it just depends on identifying the items that cause the adjustment. So our adjusted PE in this case, adjusted PE is sitting at 16.5. Now, if we use that adjusted PE, right, then that's our multiple. So therefore, if we want the value of the company, we'll take the 16.5, we multiply that by 2, the answer we get there will be 33, right? Remember, the 2 was assume that that's the earnings per share of the company, 33. So again, if the earnings per share of the company was 10, so 16.5, and let's say we multiply it by 10 in the scenario, then the answer would be 165, right? So it all depends on what you do with the adjustments and the amounts, but ultimately you get to your multiple, which is adjusted, you multiply it by maintainable earnings, and then you'll be able to get the equity value of the company. Cool. So now let's summarize everything and do one last example in order to make sure that we're all on the same page, right? So let's assume that you've got an entity B Limited, and B Limited, we're told there's a profit after tax of 2 million. We are also told that included in this 2 million, right, is depreciation of 20,000. We're also told that their salaries, however, these of temporary staff, which are sitting at 50,000. So these are the costs. We're also told there was a loss in the year, and the loss was 500,000. We also told there was revenue from a contract that was for 1 year, and the contract value was 20,000. So we'll just make the costs in brackets here, so that they are not confusing us. And then we're also told that we've got a share in associate profit, and that's valued at 1 million, at 1,000, sorry. So the entity has a profit after tax of 2 million. These are the items that have been included inside the 2 million. Cool. Now, we're also told that the company is unlisted, right? So we know that because the company is unlisted, we then have to look at a comparable entity ratio or comparable listed entity. We're told that from a comparable entity perspective, comparable entity A is a PE or is a PE ratio of 20. Comparable entity B has a PE ratio of 25. Comparable entity C has a PE ratio of minus 10. Okay. We're also told that the industry average of the is 40. Okay. Now, the company is trading with a share price of 30. We're also told that the company has a current growth of 5%. However, other entities in the industry are growing at 25%. This is the market growth rate. So the market growth rate of that industry is 25%. However, this entity is growing at 5%. Now, we're told again, should we buy this entity? That's the question. Buy the entity. Should we buy the entity? Now, how would we go about answering this question? In answering this question, what will be important is firstly determining the multiple, right? Now, the multiple in this case, we know that we've got company A, we've got company B, we've got company C. Now, we know that company A has a P ratio of 20, company B 25, this is minus 10, and then the industry average is 40. Now, we firstly have to eliminate the things that we're not going to use. We know that we won't use industry averages. Why? Because industry averages, right, are a problem, right? We shouldn't be using industry averages because we're looking at an unlisted entity. An unlisted entity, we want to look at comparable listed entities. So we're not going to use that. If we look at the comparable entity C, again, we're not going to use this because this is an outlier. It's got a negative PE ratio where the other comparable entities are positive. So we're not going to use this. So therefore, the only entities we're going to use are A and B. If we take an average of these two, we'll see that our PE ratio average of these two entities will be 22.5. Now, this 22.5 will then need to be adjusted. What type of adjustments do we need to make? For example, for the discount, for liquidity and marketability, we know that there will be a minus 2 here, for example, factoring in the fact that our shares are less marketable. We're also told that we've got a slower growth. In the scenario, they mentioned that there's a slower growth. So again, we just create a number. It's a bad thing, yeah. So we just say -9. But again, guys, it doesn't really matter the numbers per se. What's important is you understanding the adjustment that you're making. So in this case, our adjusted multiple in this case will be 11.5. It is this 11.5 that we must then use to multiply by maintainable earnings in order to get the value of a company. Now, let's go back to understand what the maintainable earnings would be. So we're told that the profit after tax is 2 million. So in order to get our maintainable earnings, right, we need to then do a comparative calculation here and see what we're going to remove from this 2 million, right? First thing is depreciation. Is depreciation recurring? Absolutely, guys. Remember, depreciation is a good thing, right? It's recurring most of the time is because of the assets we hold, and there's not enough information in the scenario to tell us that the assets that we're currently holding won't be able to be maintained in the future. So we keep the depreciation. What about salaries? Salaries in this case have to be adjusted. Why? We're told that these are temporary staff, so they're not expected to recur in the future. Again, guys, the loss that we're making here is a once-off item, so we have to adjust for that. Revenue, again, the revenue is for 1 year, we have to adjust for that. How about the share and associate profit? Now, with the share of associate profit, typically those are non-operating assets. They're typically valued separately. So that's why we're not in the business of selling associates or something like that. In this case, if we assume that if again is in the financial services industry, then potentially, if we're in the financial service industry, it will depend, right? But if we're in a business of maybe providing, retail services to clients and not necessarily providing investment services, then that share of associate would be non-operating, would probably have to be valued separately. So therefore, in this case, our maintainable earnings will have to be the 2 million, right? Then we have to add back the salaries of 50,000. We have to add back the loss of 500,000. We have to subtract the revenue from the contract and potentially subtract again the share of associate, which is valued separately. Then once we do that, the answer we get here should be 2,529,000, right? Now, if we want to get our value of the company, right, we already have the maintainable earnings. So this is what we call the maintainable earnings of the company. So if we want to determine the value of this company, right, what would be the value of this company, guys? Remember, from the bottom here, if we scroll down quickly, we determine that that's our multiple, or that's our multiple or comparable multiple. Now, we need to multiply that 11.5 times, right, the maintainable earnings that we calculated of 259 or 25, sorry, 2529,000. So the 2529,000 is the adjusted profit that we calculated there on top. Then the answer we get here should be 290,83500. So if we assume the number of shares outstanding in the entity is 500,000, so we have to divide this answer of 29,083,500, which is basically 11.5 times 2529,100. Then the answer we get here will be 58.167 per share. Now again, guys, this 58.167 is the value of the company, and it's higher than the share price. And because it's higher, we're going to buy again. Cool. That brings us to the end of relative valuations, guys. So what have we taught you today, right? We've taught you that a relative valuation is basically a valuation in which you take a comparable asset and you use the value of that comparable asset in order to determine the value of another asset. We then determined that the most important thing when doing a relative valuation is to look at some type of comparable multiple and multiply it by the maintainable earnings. If you take a multiple times the maintainable earnings, you'll get the value of a company from a relative valuation perspective. We also told you that there are two types of multiples that you get. You get a price multiple and you get an EBIT or an enterprise value multiple. If you perform a valuation using a price multiple, the outcome or the product or the answer you get there will always be equity. If you do an enterprise value multiple calculation, the outcome you will get there will be the value of your assets fair value. You still need to add the value of your non-operating assets and subtract your liabilities in order to get the value of the ordinary equity of the entity. We then discussed that there are two different approaches to use when valuing a listed entity and a non-listed entity. When valuing a listed entity, the valuation is always from the perspective of an industry average or a sector average. Whereas in a non-listed entity, the valuation will always be from a perspective of a comparable entity. Hopefully this was helpful, guys. We'll see you in the next series. Don't forget to comment and like the video, and see you next time. Thank you so much. Bye.